Four stocks I'm buying now, November 2025 edition. Welcome in, folks, to my favorite video I do for you each and every month. I'm going to have some major upside stocks to share with you here today and why these stocks have so much upside ahead. We're going to get into all that in this video here today. Three of these four stocks I'm about to share with you are hated stocks over the past year or two. I mean, absolutely hated stocks. Now, you might say, why would you want to be buying some hated stocks? Doesn't that mean they're bad? Doesn't that mean they're not going to do well over the coming years? Well, here's what you got to understand, okay? Many of my best performing stocks I've ever owned in my life, we can call it the game changers, the portfolio changers, the life-changing stocks, right? Many of those stocks were absolutely hated stocks. A la Palantir. Palantir was a $6 stock in 2022. The stock had fallen 70, 80%. People hated this stock. They thought it had no future. Today, people are willing to pay $200+ for Palantir stock. SoFi stock was a hated stock just last year in 2024, right? This was a $6 stock last year. People thought it had no future. Now people are willing to pay $30+ a share. Meta stock in 2022, somebody sold me shares at $88.94 for the stock in 2022. The same stock that a year before they were willing to pay $300, and now they're willing to pay $650 for, right? Tesla stock, one of my best stocks ever back in the day, right? When I started buying in that stock like 2018, 2019, that stock had been dead money for like 5 years. People thought like the stock was never going to move forever, right? I saw an opportunity, and obviously we made some life-changing money in regards to that one. Celsius Holdings, just 9 months ago. This was a very hated stock. You could buy shares at $21. Today, people are willing to pay $59 for that hated stock because it had crashed from 100 down to 20. AMD, look at this, just a few months ago. Just a few months ago, when I would talk about AMD, people would leave comments like, oh, it's advanced money destroyer, right? Advanced money decimator, like things like that, right? As a play on the AMD word choice. And now people are like, oh, it's advanced money duplicator. We're now at $374,000 on that stock, right? So you look at these gains over time, right? 142% in Celsius so far. Tesla was a life changer. Meta, $848,000 of profits there. SoFi, 269% profits. Palantir, 2,716%. I can go through a long list of hated stocks. Sometimes those are where you'll find the best return profiles you could ever imagine. When a stock's super loved, doesn't mean you can't make money there. It's just there's not as much money to be made, okay? I hope you guys enjoyed today's video. I hope you learn from the process in this video. Whenever I share these stocks with you, it's not just about the particular stocks, it's about the process. Somebody that's been doing this for 17 years now, stock picking. One thing and one thing only I need from you guys, if you please just smash that like button on this video. That would make my day. That's all I need from you. That's your whole payment for today. Just hit the little like button. I hope you can do that for me. It means so much. And additionally, if you want to be subscribed to the channel, you can certainly subscribe. We are now at, oh gosh, well over 900,000 subscribers here on the channel, okay? Just in the past week, we have received over 500 applications to join the Prep Stock Group. That's unbelievable. I'm super happy everybody's taking investing serious or starting to take it serious and being like, hey, you know what, let me get up to a higher level. Let me get access to all Jeremy's course curriculums and things like that, right? I'm likely going to close my private stock group to new members, likely I would say in the next 30 to 45 days. And the reason being is it's just been overwhelming demand. Like we're not used to 500 applications, like, an average week, maybe 100 applications. And I have a very small team, so we can't keep like this massive influx. So if you want to join us in the private group before I close that down to new members, pinned comment down there here today. Click on that, fill out a form, see if we can get you access in there. It's mayhem. Mayhem in regards to that right now. It's insane, right? And then as far as when I would open it back up to new members, I would say at some point in 2026. When you join us in there, we'll send you your Steel membership cards, private group card, 1000X card, and if you join us on a lifetime basis, your lifetime access card. Ooh, I can't even show you that one. That was just too beautiful. Okay, alrighty guys, let's go ahead, let's get rolling here. Number one of these four stocks, this is a value stock, a dividend stock, and it's got 10 years of growth ahead. And you know what stock it is? Cheesecake Factory. This photo is actually, I ate at a Cheesecake Factory literally last night, okay? And so Cheesecake Factory, some people look at the stock and they're like, big deal, Cheesecake Factory. This is one of the most exciting stocks, in my opinion, in the entire stock market one can invest into for the next 5 to 10 years, okay? They have unbelievable growth ahead for this company, right? Now, Cheesecake was a loved stock earlier this year. The stock had ran from, let's call it the 40s all the way into the 60s, but now only sitting on a 4% gain over the past year on the stock. And it's actually starting to turn into a hated stock. And wouldn't you believe it, right? And a lot of this has to do with the analyst community. So a lot of analysts have gotten very negative on Cheesecake here very recently. You look at the dates in regards to these, a lot of October 29th, right? Cheesecake Factory is maintained at neutral by B of A Securities. Neutral just means, like don't buy it basically, right? And you might wonder, like, who is paying attention to these analysts? A lot of funds pay attention to them, hedge funds, a lot of high net worth individuals, things like that, right? It's not the right strategy, but a lot, they carry a lot of weight. Cheesecake Factory is maintained at underweight by Barclays, basically saying it's going to do worse in the market. Wells Fargo maintained their equal weight, basically saying it's not even worth it. It's just going to do what the S&P 500 does. Like equal weight is just a fancy way of saying just buy the S&P 500, right? Cheesecake Factory price target cut to $60 from $70 by Raymond James. Obviously, that's a negative there. The big dog, JP Morgan, they just cut their price target on Cheesecake to $52 from $57. They maintained an underweight, basically saying it's going to do worse in the market, right? That's what we have going on. But there's a few analysts, not very many, that are actually positive on Cheesecake. Cheesecake Factory is maintained at outperformed by Mizuho. They believe the stock's going higher than the market in general. Cheesecake Factory is maintained at a buy by Citigroup. So not everybody's bearish on Cheesecake, but for the most part, people are kind of like, okay? No. The question is, what did the analysts say? Okay, what do the numbers say? Math matters, okay? We're going to talk about that in this video. Math matters, okay? Here's what the actual numbers say at Cheesecake. I posted this inside my private stock group in the income statements tab where I grade income statements, okay? And I teach you guys how to actually grade your own income statements. So when it comes to Cheesecake, this was a B plus grade, very good, $907 million of revenue from $865 million of revenue. They brought down your two big expenses as a restaurant chain, right, are food and beverage costs and labor expense, and they brought both of those down as a percent of their revenues, which is impressive overall. Their income from operations went to $37 million from $33 million. Net income went to almost $32 million from $29 million. Diluted EPS 66 cents versus 61 cents in the same quarter last year. So every metric you can pretty much look at in regards to Cake is all trending in the right way. Revenues trending up, margins trending up, profitability trending up on a net income basis, diluted EPS basis, even on a basic basis, everything across the board, right? Now, this is from 1000xstocks.com in the transcript feature. And this was very important, okay? Look at this here for the businesses. Total sales in North Italia, that's their chain that they're going to be able to grow massively in the Italian category for the next probably 10 years. That revenue was up 16% year over year, okay? Other FRC sales from their other concepts, that was up 16% year over year. That's a huge opportunity for the company to expand over the next 5-10 years, right? Additionally, Flower Child, which is the biggest thing the company has going on. That's the one that they could explode to, 1,000 locations, maybe long-term, or certainly at least 500. Flower Child sales were up 31% year over year. And look at even their external bakery sales had a booming quarter. External bakery sales was up 20% year over year. Now, you look at all those numbers, here's the issue, if we want to call it an issue, is Cheesecake Factory, the Cheesecake Factory brand restaurant, that's such a huge component of Cheesecake's overall revenues, and that was only up 1% year over year. So basically, these other categories are much smaller, but they all have unbelievable growth, but they kind of get, let's call it, drowned out because Cheesecake raw number is so big, and that business isn't growing that much, right? But here's my opinion on all this. Who cares? Who cares if Cheesecake's not growing much? I don't care. Like if Cheesecake revenues are flat, they're up 1%, 2%, 3%, right? I never expect Cheesecake Factory brand to have some booming sales or something like that from that particular chain. Like that's well established. Like it's always busy. Like it is what it is, right? They put up their numbers and that's great. That's an ATM machine to feed North Italia, to feed Flower Child and other concepts for growth. It serves a very important purpose for the company overall. You have this stable cash cow of business that's extremely profitable that then you can take that money and you can do share buybacks with it, you can pay dividends, and ultimately, what can you really do? Expand locations, which is really what you want to do because that's where your major growth is. Your major growth is not in Cheesecake Factory, it's in Flower Child, it's in North Italia, it's in the other concepts, or heck, even the bakery was a booming business, right? Now, the other thing you got to understand about this stock is if you look at this industry this year, this industry has been a dumpster fire. It's a hated industry in general this year, right? Cheesecake Factory is down about 2% so far this year. Texas Roadhouse down 11%. Starbucks is down 12% this year. Wingstop is down 27% this year. Chipotle down almost 50% this year, down 47+%. Cava, Kava, down 54% this year. Oh my gosh. Okay, this industry sucks this year. What else are we going to say? Okay, but the moral of the story is cake is actually doing very well compared to these other, you would expect, given if I told you all these other companies, Texas Roadhouse, Starbucks, Wingstop, CMG, Cava, you would assume cake would be down easily double-digit percentages. But the business is so strong, it's been hard to send that stock down like all these other stocks have been going down, right? You want to look at Sweet Green. Sweet Green is supposed to be kind of like a Chipotle, but for salads. Sweet Green stock this year is down over 80%. So when you look at cake, down 1% or 2% for the year, right? And you look at all these other stocks just getting absolutely pummeled, just understand cake's doing a lot better job running their business than these other guys are, right? And the other thing is, what? Protection. Cheesecake never trades at crazy valuations. You buy a restaurant chain that has no profits or trades at super high P's, you're setting yourself up for a dangerous situation. Cheesecake, 13 forward P. That gives you so much protection from the downside when you trade at that low of forward P. It's not even funny, right? Here's my base case for Cheesecake. Here's what I think is going to happen with the stock over the next few years and why this is not a boring stock. This stock is going to be very exciting over the coming years, okay? I believe starting in 2026, they're going to be able to do 7%-ish revenue growth per year. And the reason being is I think we're going to be able to get 1 to 3% a year from Cheesecake, the actual, big chain, okay? And then as far as Flower Child, North Italia, and the other businesses, we're going to get double-digit revenue growth, but those bases are going to continue to grow bigger and bigger and matter much more for the overall revenues for the company, right? So I think 7%-ish revenue growth per year, 2026 to 2029 is very realistic. And I think they'll get a little lift on the net income because I think ultimately I'm looking at North Italia and the amount of liquor sales that happen there, that straight profit. And then Flower Child sets up very well because that's actually a lot of to-go business. I think around half their business, if I recall, is to-go. That's massive. That chain's set up phenomenal for to-go business overall, right? And delivery and all that stuff. So I think they'll get a little lift in net income and margins over the next few years. So I think they'll be able to do 9% net income growth per year on average, right? Now, if you got a restaurant chain here growing 7% per year, top line, 9% bottom line, you're going to be able to command a PE that's at least in the mid-20s likely, right? So I put a 25 to 30 here, and that puts the stock somewhere between 123 and 148 come 2029, which gives me, let's call it a high 20s to low 30s CAGR. That to me is not boring. This is what I expect. This is my expectation here. This is like my 80% probabilities to be roughly in this ballpark here. There's no boring stock. This is one of the most exciting stocks to buy for the next 4 years, in my personal opinion, right? This is my bear case for Cheesecake, okay? This would mean kind of like flat revenues every year for Cheesecake 2026 to 2029, right? Which I don't think is very realistic, but that's assuming that. 5% revenue growth, 5% net income growth, so they get no lift in regards to their net income, right? 14 to 19 PE. And still, I get a 6% to 14% CAGR on the stock at a 14 to 19 PE. So even in my bear case, it's still a moneymaker. It's still a moneymaker, right? So here's the way I'll put it to you in regards to cake, okay? And if I had to put it as simple as possible. For every $1 I put into cake, I expect to get $2 to $3 out of the stock over the next 5 years. That's a very successful investment. If you could tell me I can put $1 into something and I'm going to get $2 to $3 out of that thing over the next 5 years, I'm always going to take that. It's just, I got to take it. It's too much money to not make it. I got to take it, right? And the way you got to think about cake is it's not just in regards to how much you go up on the stock over time, right? Because they pay dividends every 3 months to all the shareholders, right? Every 3 months, company pays dividends. And over time, I'm sure as the profitability increases, I'm sure they'll up that dividend in the future, right? So think about it in terms of, if you buy, cake stock at $47, right? You might be thinking about when it goes to $57 and $67 and $77 and all those things, right? Respect, we're trying to do that as well. But also you got to factor in all those dividends received over time. And then you take that dividend money and you either buy more cake shares with it or you buy other stocks, right? It's beautiful. Is it beautiful? Okay. So I love cake stock. I think it's one of the most exciting stocks in the stock market. I've been talking about it for the last few years. I've made a lot of money in the stock, a lot of money. And I think it's just the start. I think there's going to be so much money to be made in the stock over the next 4, 5, 6 years. It's ridiculous. Okay. Alrighty. That's number one of these 4 stocks. Number 2, 4, this one's a turnaround play, a dividend stock and a value stock. Okay. You want to know what it is? It is Estee Lauder, EL stock. This is a sleepy stock, right? I'm now $42,000 on the stock. That does not include any dividends received from the stock either. $42,000 of gains, and it's actually a relatively new investment for me, right? Do not check out on this stock. When I bring up a stock like Estee Lauder, I know like 90% of my audience is males, right? A lot of people like, oh, it's perfume and beauty products and makeup products. They just check out. No. So I want to hear about the company and they're going to go to Mars someday, right? Listen, some of the most money you'll ever make in the stock market, definitely not betting on companies that are going to Mars. Those are going to zero, okay? It's betting on companies that are in the beauty industry. I can tell you some of the best stocks I've seen in my 17 years in the stock market were beauty-related companies. For instance, one of my best stocks ever is a company named Elf Cosmetics. Unbelievable returns, game-changing, life-changing returns in that stock. Another one of the best stocks I've ever seen is Ulta Beauty. Ulta Beauty, I remember that stock in like 2009, like January 2009, that was like a $5 stock. By January 2024, 15 years later, we're talking that stock was like, almost a $500 stock. You almost got 100x on that, right? Now, I'm not saying EL stock's going to be 100x or 10x or anything like that, but there's a lot of money to be made in the stock. And never check out when it comes to these makeup beauty companies. Their margins are phenomenal. They have loyal customer bases that continue to buy those products over and over again. Do not check out on these companies. They are some of the best opportunities you will ever find in the stock market if you get in at the right price, okay? Now, the brands owned by Estee Lauder, they have a ton of different brands, but some of the ones that are Avinda, that's a popular one in the hair care space. Bobbi Brown, Clinique, obviously the Estee Lauder brand. Jo Malone, I love their colognes, and some of their other products smell phenomenal around your house. Kilian Paris, La Mer, very popular for skincare. Le Labo, they have MAC, The Ordinary, Tom Ford Beauty, Too Faced. Those are just some of the brands for this company overall. Okay. Now, the turnaround's happened. It's now occurring for this company now at this point in time. The company had revenues that were going the wrong way. It went from negative 4% revenue growth to negative 6% to negative 10% to negative almost 12%. Now they just flipped to revenue up 3.57% year over year. The turnaround is happening like right now, okay? So it's not like, if you bet on the stocks 3 months ago, 6 months ago when I first started betting on it, it was like you had to have a belief that the turnaround was going to come. Now you have the proof that the turnaround has come, right? Now, the thing you got to understand about EL is this used to be a great, consistent, growing company prior to Rona, okay? Look at their revenue growth, 14%, 16%, 18%, 13%, 7%, 7%, 11%, 9%, 10%, 15%. Before Rona, this was a consistent, growing company. Rona messed up a lot of things for the business model, right? You had the online channels become much more relevant, and the companies had to pivot it to now they're on Amazon, now they're on TikTok Shop, so they've now pivoted, and so they've started the turnaround in regards to numbers and whatnot, but Rona definitely messed them up in many various ways, right? And the company's now adapted, and that's what we're going to start to see in the numbers. But you got to understand, this stock was a beast. Like January 2010 through January 2020, this stock returned 745%. Once again, do not sleep on these companies. When you got a great opportunity in the beauty industry, those are literally some of the best returning stocks you'll ever find in your entire life. They'll beat tech type returns over the years, right? Now, this was Estee Lauder's most recent report here. They just came out with literally a few days ago. 4% net sales growth, 5% gross profit growth, right? Gross margin of 73.4% from 72.4%, right? Their operating expenses, they brought that down very nicely year over year, down 7%, which means your profitability is going to skyrocket. So they've swung to an operating income now of $169 million from a $121 million loss. Operating income margin, 4.9% versus negative 3.6%. Net earnings on the company, $47 million versus $156 million loss. This is just inning one of the turnaround, ladies and gentlemen. This is inning one, okay? Now, we'll call it inning two. Inning one was doing all the job cuts, having to restructure the business, like getting, in the online channels and things like that. We'll call this inning two of the turnaround, okay? There it is, right there, okay? Now, you're going to watch is their revenues continue to go up, and then you're going to watch their net income, you're going to watch their operating income absolutely explode to the upside for this company. Because remember, they're remaining employee light now, so being that they did all these big job cuts and now you're going to have revenue going up again for the company, profitability is going to explode for this company. Now, as far as where this company used to be at net income wise, they used to do $2 to $3 billion on a good year for net income, okay? That's what I believe this company is going to get back to. There's no doubt in my mind because they're going to get their revenues back. But the difference is this time, they're actually going to have an employee base that's way leaned out versus what they used to have. So I think ultimately we look at this company a few years from now, they actually have the biggest net incomes we've ever seen in the company's history. But given that I think it's kind of in the bag that they'll get back in the next 2 to 3 years to $2 to $3 billion in net income a year, right? Basically, you can say, okay, a 30p is what you'll pay for a company like Estee Lauder, since it's almost seen as like a SaaS play in regards to like people just continue to buy the product over and over, right? You run out of your makeup, you go buy more makeup. You run out of your skincare, you go buy more skincare, right? So that puts this company, in my opinion, in the next 2 to 3 years at somewhere between a $60 billion and $90 billion market cap, right? Right now, the company is just over a $30 billion market cap. So basically what I'm saying in regards to EL and why this is such an exciting stock is this is a 2 to 3x stock, in my opinion, over the next 24 to 36 months. There aren't a lot of opportunities in the market I can see out there that in the next 24 to 36 months, I feel like I'm going to double or triple up my money. Not very many. And the best part of this is, even when I double or triple my money in the stock, right, I'm going to be able to hold it for years to go after that. As long as the business is in the right trajectory and I'm confident in the management team and the strategies, like I'll be able to hold this for 5, 10, 15, 20 years in the future. These are timeless brands. Many of their brands have been around for, 30, 40, 50, 60, 70, 80, 90 years. It's not like these are just, came out of nowhere. No. They've been around a long time and they got a long way to run in the future. So even after I get my 2x, my 3x on the stock, I could easily hold for years to go in the future and then likely continue to get gains in the stock and make all that sweet dividend money. Keep that in mind, okay? EL, I love that one. Number 3 of these 4 stocks, let's be honest, this is just a pure growth company, okay? Growth, and growth. And you want to know what it is? Amazon, otherwise known as Amazing Zon. That is stock number 3 of 4. Now up $175,000 in the stock in the public account. I own the stock in the Patreon portfolio heavy. I own this stock in my private portfolios. Like, Amazon, this is just a stock you have to own. You have 3 core businesses of this company. You have the e-commerce business, you have the AWS business, right? And you have the ads business. Now, you have a bunch of other random businesses off of those, but those are the 3 core businesses of this company, right? Now, Amazon is actually a hated stock, believe it or not. And it's just started a new move here recently, so it's starting to get people a little excited. Like, this is like move in the past week, basically, that's starting to get the stock moving. But this stock has been destroyed by the S&P 500 and the NASDAQ over the past 5 years. They may say, why? How? Amazon's grown their business so much the last 5 years. How could they have gotten outperformed by the S&P 500? And not just like a little, wrecked. This company's been wrecked by the S&P 500 and the Qs. 53% gain in the past 5 years. The S&P 500 is up 95%. The Qs are up 114%, right? People are like, this stock is just the worst, right? Here's how that happens. 1, 5 years ago was Rona, right? Everybody is forced to be home. You got the lockdowns or whatever you want to call it, all that stuff at that particular time. Growth rates were exploding for Amazon. People thought that was going to last forever. Those sorts of insane growth rates, obviously, they're going to even out over time, right? So you have that come down. Additionally, people were willing to pay any price for Amazon stock at that particular time because the e-commerce growth was so strong, the AWS growth was so strong. They're willing to pay anything for Amazon, right? When you're willing to pay anything for a stock, there's going to be a lot of pain to come in the future. And that's exactly what we've seen and we witnessed in Amazon over the last 5 years. Massive underperformance. But what you're going to witness over the next 5 years is not only outperformance of Amazon versus the Qs and versus S&P 500, but it's going to be massive outperformance. It's not even going to be in the same stratosphere. You're going to look at Amazon's returns over the next 5 years, and you're going to look at the S&P 500 and the Qs over the next 5 years, and they're not even going to be in the same ballpark. You're going to be in complete shock by how much Amazon essentially outperformed the indexes in general, and honestly, a lot of the Mag 7 stocks as well, right? No, what Wall Street cares about more than anything else, and this was posted on the 1000X X page actually, is AWS growth, Amazon Web Services. And what we just witnessed is a major acceleration of AWS growth, and that's what everybody's been waiting for. And that's why the stock has all of a sudden started to move up in the last week, because they reported this AWS growth was much better than expected. And all of a sudden, Wall Street's like, Amazon's back, right? Now, additionally, just today, Amazon and OpenAI announced a multi-year strategic partnership. It was a $38 billion deal for AWS, which is quite substantial, right? Now, additionally, in regards to Amazon, is they are laying off 14,000 corporate employees right? And in regards to this, Andy Jassy says it's a culture. It reminds me a lot of Meta's move in 2023. So kind of at the end of 2022, in the beginning of 2023, Zuckerberg did a mass layoff at Meta, right? Mass layoff, leaned out the organization in a substantial way. And Meta had been overhiring for years, kind of like Amazon likely overhired as well. And Zuckerberg realized, like, we got a lot of players that are not A players at this company. I guarantee the same thing happened at Amazon. They probably hired so many employees that were just okay. And if you want to be a high-performing organization, you can't hire okay people. You need to hire the best of the best. And there's just no way a company like Amazon, everybody there is the best of the best. There's just no way they're all A players. Not going to happen. They probably had a lot of D and C players. They probably did, right? Maybe even some B minus players. And they said, we got to get rid of those individuals, right? That's what ends up happening. And so that's business, right? It's not personal, it's business. And they had to make that move. And what that's going to end up producing is likely Amazon's culture is going to end up being a lot better over the coming years, right? Because A players don't want to be around C players. I can tell you that much. That's brutal. It brings the whole team down essentially, right? And additionally, this is obviously a huge cost-cutting measure. It hurts profitability in the short term because you've got a bunch of one-time costs that kind of take effect over a quarter or two. But over time, obviously, it's going to bring down Amazon's expense profile substantially, and their profitability is going to explode way faster than revenue. So if you're thinking about this company growing revenues at 15%, let's say, don't be surprised if net income's going up at a 30 or 40% clip in that sort of situation, right? Now, in regards to Amazon's latest quarter, $180 billion from $158 billion. Income before income tax is $28 billion versus $18 billion. Net income over $21 billion from $15 billion in net income. Diluted EPS $1.95 from $1.43 for Amazon. Huge improvements there, right? Now, the only thing I kind of poked at and why I gave them a B- grade is some of their expenses were definitely high. Cost of sales was a bit high. Technology and infrastructure was a bit high. And then they had this total operating expense that hit them. That was about $2.8 billion there. So that's why I graded them. Now, what's my bull case, base case, and bear case for Amazon? Well, here's the thing you got to understand. Listen, I might take these numbers up. In regards to my bull case, my base case, my biggest thing is I need to see that AWS growth next quarter. If that AWS growth accelerates again to, let's say, 22, 23, 24%, all my numbers you're witnessing here have to go up on my bull case and my base case, okay? So just understand what you're seeing in front of you right now. I might have to make adjustments 3 months from now, okay? I'm doing 14% revenue growth as of right now for 2026 to 2029 and 20% net income growth, okay? If you got that company like Amazon growing at those sorts of rates, 35 to 40 P is fair, rated about a double an average stock in the market. They're doing over double revenue growth, over double net income growth. So you should be able to command at least a double PE, right? 20 to 24% CAGR in the stock over the coming years, right? Remember, if AWS growth goes 22, 24%, 25% or something like that, this bull case you're witnessing here, this is going to become my base case essentially, okay? My base case, honestly, probably need to take that up to where the bull case is right now, right? Because as of right now, my base case has only 12% revenue growth, which is, much slower growth than obviously what they have right now. Net income growth at 18%, 33 to 38 P would be fair for a company like Amazon growing at this sort of rate, which gives you a compound annual growth rate of 16% to 20% for this company. This probably needs to come up, right? My bear case, I won't move this one. I'll keep this one here. 10% revenue growth on average per year for the next 4 years, 15% net income growth on average for the next 4 years, 30 to 35 PE, and I still get a double-digit CAGR between now and 2029. I got to buy it. Like, you got to own it, man. Amazon's a must-own in every single portfolio out there. It is a must-own. Number 4 of these 4 stocks. Whoo, this one's interesting. Okay, this is a turnaround play. A value stock and a dividend stock, okay? They just started paying a dividend. They're going to pay their first dividend ever. This is an ultra level of hatred for the stock. And I understand it, but I don't really care. The stock's going to do amazing. Oh, it's funny. An Amazon truck's literally going by my house right now, okay? You know what I know what stock it is? PayPal. PYPL. A $68 stock. This has been a brutal stock the past 5 years, down 63%. And you know how much I could care about it? 0, like Robert De Niro. I don't care. Okay, here's the deal in regards to PayPal. The company for good reason, was a company that people hated, right? I mean, the revenue just kept getting worse and worse. 9% revenue growth went down to 8%, went down to 5%, went down to 4%, went down to 1% revenue growth, right? I understand it, but that's the old and this is a new, and the turnaround has clearly started. It went from 1% revenue growth to 5% to this latest quarter over 7% revenue growth. And the stock's not reflecting it. The stock is not reflecting the fact that this business model has changed. In my opinion, it's a lot of tax loss harvesting you have at the end of the year, right? There's basically almost everybody that's ever bought PayPal stock has lost money. So if you need a stock to sell and write off against your gains, in your other stocks, so you don't have to get hit by as big a tax bill, look no different than PayPal. But the bottom line is the turnaround's clearly started. It's mathematically proven now at this point in time, right? The income statement was a grade A. Great numbers. It would have been an A+ if they just had a little faster revenue growth, right? If they had like double-digit revenue growth, I would have graded them an A+. $7.8 billion of revenue went to $8.4 billion of revenue. Operating income went to $1.5 billion plus from $1.3 billion. Income before income taxes went to $1.5 billion from $1.3 billion. Net income went to $1.2 billion from just over $1 billion. Diluted EPS $1.30 versus 99 cents. What is my bull case, base case, and bear case for PayPal stock? This is my bull case. 9% revenue growth on average per year, right? Venmo's grown revenue 20%, they said in this latest quarter. 11% net income growth. 20 to 25 PE, nothing crazy at all for a company growing 9% and 11%, top line, bottom line. 20 to 25 PE, that's basically just a market multiple with above market multiple revenue growth and net income growth. That gives me a compound annual growth rate in the 20s to potentially 30%. Like, steal deal. My base case, this is just a fancy way of saying what I expect for PayPal, 7% revenue growth on average, 2026 to 2029, 9% net income growth on average, 2026 to 2029. We got an 18 to 23 PE, steal deal, right? That's higher revenue growth than average and higher net income growth than average, and just a PE that's basically average or even below. And I get a 20%-ish CAGR on the stock. Got to buy it. Even my bear case, only 3% revenue growth, right? 5% net income growth, 14 to 17 PE, and it's still a moneymaker. Give me the stock, man. Give me the dang flipping flapjack and stock. Flip my flapjacks. That's a holy smokes, this ain't no jokers. Like, gotta take it, okay? The thing I want to leave you with in this video here today, there's a lot of talk out there in the stock market about this company's going to do that, this company's going to do this someday, blah, 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 right? And hopes of this and dreams of this and those sorts of things. And a lot of that you get into when you've been in a 3-year bull market, right? Math matters. You got to bring it back to the math. And what I just took you through here today is not just talk about what the business models can do, right? And there's this business line and cheesecake, they could grow in North Italia and Flower Child, blah, 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 right? It's bringing it back to the math. What's the valuation right now? What's the valuation likely to go over the next 4 years? Am I getting a great CAGR on the stock likely? Yes. The math. Run it back to the math. You got to work your math. You got to run your projections whenever you go to buy a stock. You don't do that and it'll come back to bite you huge. Come back to bite you in 2 ways. First, you will get into stocks that will produce you horrible returns. Some of these stocks I just shared with you have been horrible performers over the past 5 years. I do not believe they're going to be over the next 5 years, but they were horrible because people didn't run their math and they paid crazy valuations for them, right? That's a problem. And 2, you got to figure out, like, is this a good deal or not, right? Because if you get into a stock, and let's say it doesn't do horrible, but you could have gotten in another stock that would have done a lot better if you just ran the numbers and ran the math and took out opinions, right? You might have realized, oh crap, man, I made 5% a year on this stock, right? From 2026 to 2029, maybe you make 5% CAGR versus you could have made 15% CAGR or 20% CAGR on a stock, right? And that completely changed your profile, and that completely then changes what? Your lifestyle, your dreams, like what type of house you can afford, what type of cars you can have, when you can retire, how comfortable your retirement can be. Can you retire family members? Can you help out family members? Can you give money to charity? And can you go travel and do the type of trips you actually want to do and live the type of lifestyle you want to do and buy the sort of car you want to buy and all that stuff? Math matters because that math then ends up dictating lifestyle long term. And once you understand that in your mind, you realize, oh crap, man, like there's a lot to this game, right? And it really matters substantially. I appreciate you for joining me here today. Pin comment down there if you're looking to apply to our private stock group. Once again, I'll likely be closing that down to new members sometime soon. So if you want to get in there before we close down to new members, and we'll reopen at some point in 2026 to new members, but that'll be pinned comment down there. Access to all my course curriculums, access to 1000xstocks.com to run your numbers, math matters, get access to the private Discord chat, see the stocks I'm buying and selling, my $4 million Fidelity account, exclusive weekly videos, all that good stuff. Take your game up to a much higher level. And then we will send you your Steel membership cards to your house, your 1000x card, your beautiful private stock group card, which that is a particular stock there. And if you join us on a lifetime basis, we'll send you your black card in the mail as well. Okay. All right, guys, much love and have a great day.